Welcome to the Motley Fool's Crunch Time series, where we scout out a single company from the story to the opportunities and risks. Time to take a closer look at struggling discount retailer Dollar General. First, my prediction. If the ongoing turnaround continues to bear fruit, Dollar General stock will make investors money over the next 5 years, but it's a little more difficult to predict that it will beat the market. Dollar General's business strategy is to put stores in locations that are retail deserts and to stock those stores with a mix of low-cost staples and cheap but higher-margin discretionary goods. By operating with a low-expense model of lean staffing and high inventory turnover, the goal is to keep costs low for its customers and expenses low for the business while making the most out of those small stores. The company had an amazing run in the first dozen years after its IPO, growing earnings per share 1,200%, rewarding investors with nearly 11-bagger returns. More recently, things have gone the other direction, with a combination of higher costs weighing on margins, rising expenses, and as CEO Todd Vasos described, financially constrained core customers dropping earnings 44% from the 2021 peak. Now, there's still room to continue adding new stores and growing the base, but much of the opportunity for investors is in Dollar General turning around a business that's gotten away from what it was best at. Inventory turnover has fallen by 21%, while gross margin is almost 400 basis points lower than levels back in 2021. This has gutted profitability and makes it more difficult to fund expansion too. Therein actually lies the opportunity. Earnings per share are down 44%. The stock is down 74%. Trades for 11 times trailing earnings. Now, here's where it gets really compelling. Today's stock price works out to 6.4 times its peak earnings back in 2022. If the turnaround is successful, today's stock would turn out to be exceptionally cheap in the future. The risks? Well, it's a turnaround. They're really hard. The company still faces many of the problems that got it here. That includes staffing challenges, inflation lifting the cost it pays for goods and expenses to run its stores, and that customer base that doesn't have the same discretionary spending power it did a few years ago. Dollar General can only control what it spends and buys, how it allocates capital going forward, so a prolonged overhang of its core customer base, that's going to weigh on the earnings and the recovery. Dollar General also has a weaker balance sheet than in prior years, with over $6 billion in debt, and its debt-to-EBITDA ratio has ballooned from 1.2 times prior to the pandemic to 2.3 times, even as it has paid down some of its debt. Now, I'm not convinced that Dollar General will beat the market going forward, but I think there is a significant margin of safety in its stock price, and the early signs are that the turnaround is working. So I do think investors who buy at recent prices are very likely to profit from that investment over the next 5 years, not as convinced that it's going to be able to outperform the S&P 500. All right, let's wrap this up. At The Motley Fool, your comments make us smarter. Please comment with your own research and insights about Dollar General. Tell us what stock you'd like to see us tackle next. And go to fool.com/invest to receive the top 10 best stocks to buy now.